Good morning. It is Friday. It's Friday, October 18th, and we just finished the first full week of earnings. It's been an eventful week. We had some stocks really fly up, like TSM, and others really crashed and burned, like Elevance and United Healthcare. And today we've got more earnings to go over. We've got a good consumer staple stock in Procter and Gamble. We've got a couple of others, kind of a little bit of a collage of stocks are announcing today. So I'll go over a few. Most notably, American Express announced. I like looking at their report because it tells me a little bit about the economy, and I'll share that with you in a bit. Schlumberger, which is really focused on the oil industry. They do services for oil companies. Go over that one. And then Ally, which announced today, and it's an interesting story. I'll save that for later. I appreciate everybody joining this morning. Android, PC, I appreciate you joining and welcome. So just a reminder, I'll be trying to stream each morning, especially during earnings. It'll be interesting to talk about the earnings that are being released each morning. And next week's going to be a busy week for me. So just FYI, I may have to miss a day or two on the morning stream. I'm pretty sure Monday is going to happen. Tuesday is likely going to happen, but Wednesday might be a little iffy. We'll take a look, or we'll see when we get there. And then in the afternoons, I stream on Tuesdays, Wednesdays, Thursdays, time permitting, and that's a good stream. That way, folks that cannot join the morning session because they have to go to work can attend in the evening. So everybody, welcome. Want to invite you to become a community member. Sign up, become a part of the community, and get more involved. We're going to have the first workshop tomorrow, and it's going to be a workshop to go over a few, I think, good areas of knowledge, and maybe help investors maybe look at financials a little better, maybe just kind of share examples of financials and go through them. To get to know a company is to get to know their financials. So I think that's always a good place to start. And each week we're going to be having just workshops, and it's going to be driven by member requests. Like, what do you want to go over this week? It will be the topics. Then on Sundays, we do an investor call, which is good, healthy exchange of knowledge, ideas, what's going on, what's working, what's not working. Type of conversation. If you want to be involved with that, become an advanced investor and you will be a part of it. So look for more details in the description of the live stream. All right, so let's take a look at where we are opening this morning, and we'll go through it. And CVS, it looks like Android PC is talking about CVS. Yeah, I'll talk about that a little later and talk about the change with the CEO at CVS. So real quick, it looks like China had a good trading session. Their market closed for Friday. They're way ahead of us. They're like half a day ahead of us. So their market opened and closed. But there was a good announcement on the economic data that they've had, which was retail sales as well as GDP. Came in quite good. And it was positive. It was well received by the market. And I believe they also had a real estate report. And the real estate market had been losing value, but it's beginning to stabilize, which was good news. In general, the positive news is probably going to cause Chinese stocks to work today. We'll see how they do. I'll take a peek at them a little later. I'll give the markets a little bit of time to update stock prices, then we'll take a look. Bitcoin is up, and let's take a look at the U.S. markets. So out of the gate, the NASDAQ is still cooking with gas. It's doing well this week. The NASDAQ's been doing really well, led by, semiconductors this week. I think had a good week overall. They had kind of a bad beginning of the week, and they ended on a positive note with TSM. But I think NASDAQ's doing well. S&P is holding it together. And then the Dow is down. I think Procter and Gamble may be down. That's, I believe, a Dow component. Then the Russell, we'll give it a little bit of time. Sometimes the Russell kind of opens up and then it really begins to tell us what it's going to do maybe a half hour, an hour into trading. Bitcoin is up. I think I mentioned that. So we covered Asia, we covered the US market. Now let's take a look at some sectors. And good morning, Mike. Yeah, we'll go over Schlumberger and Ally, and we'll go over that in a sec. So yesterday, technology led the day. Energy was in second place. And let's take a look at where they're at just in the open. Isn't going to tell us what's going to happen today, but it looks like it's still stacking about the same. So technology still leading the way, and energy is still, this probably hasn't updated. So I'll give it maybe a half hour. We'll come back to it. And this may also need some time to update, but just a few minutes into the open, it looks like Baba's working, JD, NetEase, Baidu, and Li Auto are up, which is good to see. They've been down this week. It's been a down week for China stocks, probably 3 or 4 consistent days of down price action. All right, so the main event for our stream is talking about these earnings and which companies announced today. So we had Procter & Gamble being the biggest cap that announced today, and we'll take a look at that. It's a $407 billion market cap company. They are a consumer staple stock, all the stuff that we need, for a home that we consume. Procter & Gamble's got us covered. American Express is a financial services company. Take a look at that. Schlumberger Oil Services. They help oil companies extract oil from, their holdings and then put them to market. And we've got a few regional banks. And I'm going to go down to Ally, which has been a stock that I've been tracking and have a few things to share there. In addition to that, I'll talk about Netflix, Elevance, and maybe some CVS, because Elevance did nosedive today, and I wanted to see where that was trading. We'll give that a little bit of time to stew and tell us what it's going to do today. So let's start with Procter & Gamble. So Procter & Gamble is a safe stock. It's going to be a steady Eddie. To do 16% from a Procter & Gamble and receive a 2.3% dividend, that is a solid stock. It's a very good company, very well run. It's up 44% over 5 years. You compound that, dividend, you're probably upward 55, 60% return, which is a very good return, considering that it's a very safe stock. It's not an NVIDIA-like, or it's not a Microsoft-like stock. It's just stuff we consume at home. It's paper goods, it's soaps, it's dishwashing detergent. It's the stuff we consume. So in good economy or bad economy, Procter & Gamble is going to do okay. And that's why it's held by so many investors. They like that stability. They want a stable stock. The company, I think, is fairly priced. Analysts believe that it's discounted just slightly. And this stock, I think, is one of those that it's not a bad time to look at safe stocks, because I don't think anybody's running to safety just yet. I could bet you $1 that if we had, fear of a recession, Procter & Gamble would be rallying, because investors would be all over it trying to buy it up. But at this point, I think the economy is going to be okay in 2025, and who knows about 2026. So Procter & Gamble is down a bit. The market, if you look at Procter & Gamble, right, it's a very stable stock, but you don't see, big growth in revenue. It's a negative 1% net sales. And they think that, they want to tell us that organically they grew 2%, meaning they probably sold units and so forth that were 2% higher. But the exchange rate caused that negative 1%. Well, it comes with the territory, man. You've got to absorb, currency translations. It's still a -1. So it's a very stable stock. It's very stable. It's not going to go up much. It's not going to go down much. And it's going to be very consistent in the earnings per share it produces. So the news didn't excite investors. They're looking at it and not overly excited with the company. I don't think there's anything wrong with Procter and Gamble. It's just is what it is. It's a stable, safe stock. When you look at their business, if you look at their growth, they've had really nice growth recently. In 2020, they did have negative sales growth, and that's probably related to COVID overall. Then they had really an expanding business in 2021. Now I'm looking at the wrong company. I apologize. So let's look at Procter and Gamble because I was looking at American Express. So we look at top line revenue. These are green numbers, but you can see it's slow growth. It's just going up slightly. It's a big, big company, $84 billion in the trailing 12 months of revenue. Really consistent, well-run company. It's a real stable stock. This is not the right stock for me. If I'm going to go into a stock like this, I'd probably just, kind of either buy an ETF or I would probably buy bonds and have a good rate of return and really good stability. I'd rather take my chances with higher growing stocks. They're going to have a great return. And that's where I get my great returns. And then I keep my stability with bonds and maybe a few ETFs here or there. So Procter & Gamble down 2%. It's let's see what analysts have to say about the stock. There's 19 analysts that cover the stock, and the high is 190, which isn't too far off their current stock price. On average, they're saying, hey, it's really worth 176, which is about 4% higher than its current stock price. And then the low is 159. So you can see this is a safe stock. There isn't a bunch of variability in what analysts have to say about Procter and Gamble. Looking at their earnings per share projections that are expected, and there's a number of analysts that are putting this data together. So really well covered company. It's going to grow nicely. So this is going to give, again, this should be a reliable stock. Shouldn't veer too much from where it's expected to go. It's going to eventually be about a $95 billion revenue company. So Procter & Gamble was the biggest market cap of the day. It was interesting. And we will move forward and go up and take a look at American Express. Let me say good morning, Bobby. How are you? Giga Cloud Technology. So we can take a look at Giga Cloud. It's a tiny company. Let's take a look at it. I think it's interesting. I haven't been ready to buy any shares, but let's take a look at it. I don't know that I'm going to be ready, but let's take a look. All right. So American Express. One of the reasons I like looking at American Express is it tells me a little bit about the economy, how especially business travel and kind of like corporate spend, how is it doing? And when I look at their financials, I'll probably kind of read into some of what they reported and say, this is what's going on in the corporate economy. This is what's going on with business travel. This is what's going on in that area. So the market cap is pretty substantial. One of the famous investors of American Express is Warren Buffett. He's been in it for a long time. 193 billion is the market cap. So it's a pretty good size market cap. Revenue is 59 billion. Net income is there. PE is not too bad, 20 on the current PE, and then the forward PE in 2025 is going to be, again, 20. Pays a tiny dividend. Analysts believe it's a little overpriced, and today it's fallen down 4%, and now it's 4.45%. So investors didn't like something that they saw in their earnings. Let's take a look at what their earnings had to report, and then I'll come back and show their historic trends. So one thing that I did want to note, I highlighted it in yellow, is in the third quarter, total card member spending increased 6%, and card fee revenue growth accelerated to 18%. We continued to attract large numbers of premium card members with 3.3 million new card acquisitions while maintaining our high retention rates, excellent credit performance, and expense discipline. So in general, that's good. But what I'm reading into is this increase in spend, right? It's another data point that the consumer is in good shape. The consumer has jobs. The credit, I guess, status of these consumers, I'm drawing out of this report that the consumer's in good shape. One more data point. And as I look at other stocks that have tied to that consumer, as I hear the reports that the government puts out on the consumer, as well as American Express, this is more corporate spend. It's showing that corporate spend's increasing, so business travel makes sense that business travel is increasing because now that we're through COVID, maybe sales reps are out visiting customers, maybe projects that were completely put on Zoom are now returning to in-person meetings, and there's a lot more FaceTime that employers want to have. And that coincides with a story that I noticed, which was over at Amazon, the AWS head, they've mandated a 5 days in the office work week to go back to regular times before COVID. And they're really insisting on that. So that's, again, driving a lot of in-person. And if a person needs to travel to meet with either their coworkers or meet with a partner, a customer, a supplier, then they're going to have to stay somewhere in a hotel and spend on the road. And that tends to be American Express like business. So interesting data point that I drew out. Now, the market, I think, was expecting a much better report. I think their report was very good. It's a healthy business. And when we look at their historic, trends, the revenue growth has been there for American Express. It's quite impressive. Of course, during COVID, there wasn't a lot of travel. So their spend went down substantially, right? Their revenue, I should say, went down. But they bounced back quite quickly. Boom. They went down. They went from 10 billion. Then they grew nicely in the following year. And they've continued to grow. Now they're substantially bigger than they were before. So they were, before COVID, they were roughly a $40 billion company. COVID hit, they went down to 31 billion. And then they've been growing since then. So that's really, really good. That's a sign of a strong business, their revenue growth. And the stock price was pretty much consistent with that growth. Look at their stock price, 132% upside. Very good. Over the last year, it's really worked, 78%. Phenomenal. That's a really nice graph. Now, is the stock a little too expensive? Potentially. It might just be too expensive. It's had a very good run. It's got a lot of that good fundamental data priced into the stock. And maybe investors are thinking, maybe American Express kind of hit their limit. Maybe they're not going to grow much more beyond this. Maybe there's concerns that they're going to the revenue is going to flatten out. And they're not going to be as prosperous going forward. It's one day. It's one day, but it's their earnings day. And the stock is beginning to settle down. I don't know that it's screaming at me saying it's a big, big opportunity to buy into this stock. I don't see that. I would say that their fundamentals look really strong. Their revenue, I showed you that they're growing their revenue really nice. When I look at their free cash flow, it's also very strong. You're going from 12 billion pre-COVID up to 17 billion in 2023. That's a strong free cash flow number. I would value the company based on their growth rate and their free cash flow upwards of like 240 billion, which leaves some room for some upside, action, but I would say not enough. I'm a little concerned overall with the American Express business because I think that that's a very historic legacy business that could be disrupted. It could be disrupted by a lot of these trends to go to a lot of direct payment, like Venmo and the PayPal's and Stripes and all these um, different companies are beginning to have more direct payment, methods, and I'm leaving a lot of them off. As those disruptors become successful, it's eroding the market share and it be making American Express less relevant. American Express is a concept that's been around for 100 years and they charge a lot of fees to use their network. Right now it's working, but does it have a good 10 year, path forward? That's where I would be most nervous is American Express going to be disrupted at some point and become less relevant? Their revenues will drop, their profits will drop, and then investors will be left holding the bag. I've never been in love with American Express for that reason. I'd rather go to the part of the market that competes and is more of the leader in innovations, the leader in ideas, really expanding their marketplace. So I like PayPal. I like companies like Robinhood that are taking on the market and really picking a place where they can disrupt and really grow that space, really do things in a different way that fits the way consumers and businesses want to run. The whole buy now, pay later model is now really taking shape and getting established. I think Upstart and a couple of others, those stocks have really rallied because the consumer's doing well, so the write-offs will be lower and interest rates are going down. Those two things help those new innovative companies that are buy now, pay later like companies. Again, that's kind of eroding some of the market share of the American Express, Visa, and other companies that would have probably been used to buy a big purchase, to buy a $3,000 item, and then they paid off, when they get the bill. Instead, now somebody's doing a buy now, pay later program, and it's a direct transaction with the retailer or e-tailer, and they're able to buy that good. So it's interesting to see American Express. I think it's a vote that the economy is doing well, that the consumer is doing well. American Express may be a little expensive, and analysts are pretty accurate in their observation that, hey, the price may be a little too expensive and should be toned down a bit. All right, so we're going to go over Schlumberger, Ally, and then we'll go over GCT. So Schlumberger is an oil services company. So you have oil companies that own the rights to extract oil from an area, and they have these rights, and they partner with Schlumberger, who will help them establish the facilities to extract oil and maintain that as well. And there's a lot to it. It's not that simple. So Schlumberger grows when the oil industry is expanding. Now, oil prices have been going down, so it's not a big giant surprise that we have Schlumberger down 2.6% at this point. Their earnings were pretty decent when I look at them, but I think the kind of wet blanket over oil right now is that the oil price has dropped. The tension between Israel and Iran has toned down to the point where I should say, specifically to the oil industry, Israel, I'm sure with pressure from the US, has communicated that they're not going to go after the oil fields of Iran to retaliate for some of the missile attacks that Iran launched, I think a couple weeks ago or a month ago. And that really relieved some of the tension in the oil markets, and oil prices then dropped. There was more attention or more news where the leader of Hamas, I believe, was killed. And I think that's something that Israel wanted because Hamas attacked Israel and really caused a lot of damage, a lot of loss of life, and was just completely unwarranted. So that's kind of sorting itself out, and oil prices have settled down. So that whole as oil prices come down, oil stocks and Schlumberger, which their customer is the oil company, their stocks will settle down. So as we look at the 1 month, it's doing okay. Here's the increase in oil prices that you could see. That's when it was really moving. Year to date, it's down 17%. Just oil prices have not really rallied. They haven't gone up because when oil prices are high, oil companies are profitable and they want to produce more oil. So, hey, Schlumberger, come help us extract more oil. But for now, this stock is, fundamentally it's discounted, but it's all about that commodity. As the oil price increases, Schlumberger, big oil companies will increase with it. It's not a bad idea to think about investments in the oil complex when nobody wants to buy them because then you can get them at a really good discount. And the other company that I like in this space is Pump, which is really focused on fracking, which is a very popular technique here in the U.S. to extract oil from some of the reserves that are they need fracking in order to unleash that oil. So I like Pump. Schlumberger is pretty good. I think Pump is a smaller company that provides I think a better value proposition, a better discount, and better upside. So that is Schlumberger. Schlumberger from their financials, they looked fine. I mean, net income is there. Even though oil prices are down, right? Schlumberger does not get paid, in oil. They get paid in dollars or whatever currency they made the deal in. But at the same time, it's expected that, hey, with lower oil prices, you're not going to get as much work in the future. So that's what's holding the stock down. But if you look at their fundamentals, they're pretty solid. The most recent 9 months are here. You can see that their cash from operations is higher than in the previous 9 months of 2023, and their free cash flow is higher. So they're producing cash flow. They're growing their business. A lot of their business is in the Middle East, really oil-rich countries. So you can see their revenues have expanded in their first 9 months of the year, and revenues expanded in the quarter that just closed. So Schlumberger is in good shape. It's just going to be really, really coupled to that oil price. And right now, oil prices have been going down. So we'll see how Schlumberger goes. The dividend isn't bad, 2.5%. Not bad at all. I think you can get better you can get a better dividend from an oil stock, though. I would say that. Okay, so let's go over Ally and it looks like, Mike, you keep dollar cost averaging into Schlumberger and Occidental. It's not a bad idea. Buying when nobody wants to buy is a good idea. And I know it seems kind of like a little bit long-term minded, but you make a lot of money when you buy when nobody wants to buy. You pick up stocks at a discount, and then a year later, 2 years later, you're sitting on a really nice winner, and you look back and go, yeah, that was the right time to buy, which was, 12, 18, 2 years ago was the right time to buy and load up on a stock. All right. So Ally, when they first announced, the stock rallied like 4 or 5%. And then when it first opened, I think it opened up, I don't know, down 5%. Now it's recovering a bit, 2.46. Now I looked at their earnings and I looked a little closer than the two I just shared with you. And the reason for it is I started buying into Ally. And Ally is, let me go to their earnings because it gives us a good glimpse of who they are. So Ally started, for the most part, they were a part of GM, and GM had a financing arm. It was, I believe, it was GMAC, and they ended up spinning that off. So the origins of Ally is the car finance business, and they started going into other businesses, but that's predominantly who they are, and they have grown that business nicely. They've grown to have more applications. They're kind of a dominant consumer finance company focused on car finance. And cars are a necessity in the US. This is where they operate. And car prices continue to go up. So the actual loans on those cars continue to go up. The business has grown on the auto finance side, and they've started a digital bank where they really attract depositors by providing a really nice rate of return. And that's gone quite well. So I treat Ally as kind of a bank, although they're a consumer finance company predominantly, but they do have this bank. They're trying to get into insurance, and I think they're beginning to grow. And then they do some other things, like they do a little bit of mortgage lending, not enough for it to be a big part of the business. Their results I thought were good. Their um, their finance business for predominantly their auto sales were okay. They actually, I think they decreased a bit. You could see these are actual dollars, I think in millions. And but what increased was other revenue. Other revenue, if you track that, it's really been expanding. I think that's where they're seeing some growth. I think diversifying from, away from just being a car financing company to have different, financial services and financial products is a really good idea. That way you can find markets where you can grow faster, and you can be more diversified as a business. That way, if there's a downturn in car sales, the automotive industry, you're not kind of held to that downturn. You can kind of grow in other areas and probably deal with that downturn a little better. So in general, I thought the revenue growth was good. I believe they continue to be profitable. And if you look at, this is the most recent quarter here, kind of highlighted in gray, if you guys could see it. And their earnings per share expanded. So that's good. And one thing I wanted to note is we have decreasing interest rates. Let me make this a little bigger because that is kind of an eye chart. There we go. That's better. So one of the things I've liked about Ally is their loans out there on cars is at 9.29%. And we know that interest rates are dropping. So that just creates better net interest margin. And net interest margin is profit to a company like Ally. So that looks good. On their lease business, not so good, because I think they have to factor in depreciation because they actually own the car. They're just letting somebody lease it for 3 years or however many years they're going to lease it for. Commercial auto is probably loans to the dealerships so that they can bring in inventory, put it in on their lots, and then pay an interest rate on that loan. Corporate finance, mortgage, you can see that mortgage, the yield for mortgages is not very good because just mortgage lending is safe, but it doesn't do so well. Credit card, the yield is really high. I'm sure they want to grow that as well. So all these things to me, 7.3% looks pretty good when we're looking at, interest rates continue to drop. They're probably paying 3 to 4% to depositors. So that spread's really good. So I think that looks really good. I think that stock is really being discounted because I'm going to show it on this chart because it looks better. So when I look at Ally for the last 6 months, there was a big scare that, consumers are not able to pay their car loans, and the stock sold off 24%. And it caught my attention. I'm like, I know Ally, it's a good company. I've made money on Ally in the past. So can I make money again? So I started to track the stock. I decided to start buying shares. I'm looking at the earnings. I think the earnings were good. And I'm going to keep buying shares because I think that this is going to eventually just keep going up. Over the last year, even though they dropped by that substantial amount, they're still up 35%. That's excellent. Over the 5 year, not so good, 14%. And I think we had the big downturn, coming out of COVID, they were just screaming up. And then they really settled down. But now the stock's beginning to move. I expect it's going to continue to move up and to the right. They, I think, are very well run. Cars are pretty much a necessity. And as consumers refresh their cars, buy a car for maybe the first time or whatever, they have to finance it, and they have to go to companies like Ally to to finance that big purchase. So I think it's a pretty solid business that I'm glad to buy into them. I do like their dividend rate. I don't invest purely on dividend, but that's not a bad dividend, 3.35. It's discounted based on what analysts are saying. And I think it's discounted even better than that based on my own analysis. But Ally looks pretty darn good to me. I'm probably going to buy some more shares today. I'd like to build up a position maybe of $10,000. I just started buying into them, and I'm not going to go off on the deep end too quick. I'm going to probably maybe go from right now. I have about $1,500, $2,000 in the stock. I'll probably go up to $10,000 and see how it goes from there. Looking forward, look at their earnings per share expansion. That is phenomenal. So that's looking pretty darn good, man. So yeah, I'm going to keep buying into Ally. I think that's going to be a good move for me. And I think the market they didn't like something in that report. I think they're finding reasons to sell off Ally. And they may be right. The investors might be right, and the stock, tanks. But I might be right, and I might make some money. I made money on Ally. I'm okay making money on Ally. I bought when they were like here, and then they rose really nicely, and I sold like here. Thought, okay, I made a good amount. What would be my exit strategy on Ally is probably be satisfied with like a 40% rate of return. Boom, get done. And I'd probably look at the environment, the economy, but it's not a stock that I think is going to be a long-term hold like a Meta or a Google Alphabet. It's probably something that's, let's use the advantage of the market selling it off, make a substantial amount, get out of the stock, put that cash back into the pile of cash, and look for the next opportunity. So it would be maybe a 1-2 year hold and then sell it at the right time if everything works out. So that's my plan on Ally, and the market is not treating it very nicely today. Down 4%. Well, it's an opportunity for me. All right, so let's take a peek at, I think it was GigaCloud. This is a tiny little company. And good morning, Gabriel. Thanks for joining. And Trader Prad, good morning. Very good. Good to see you guys. So let's take a look at GigaCloud. GigaCloud does a lot of the logistics for big items. And nowadays, consumers are buying everything online. They're buying cars online, having them delivered. They use, a couple of different sources for that now. They're buying, big TVs, furniture, all kinds of stuff. And the logistics around that, you can't depend on UPS or FedEx. Those guys are, kind of put together to deliver packages under a particular dimension limit. And then you have the big truckload logistics providers, which are trying to come down and do some of these deliveries. But GigaCloud is specifically focused on We're going to do the logistics for big items that are bought online, and then we'll deliver them. And they're headquartered here in the Los Angeles area. They have a super low PE. You can see the stock has really moved in the past year. It's up 185%, but boy, it's had a roller coaster existence. Part of it is because it's a small cap. It's a tiny cap by today's standards, right? $1 billion market cap, revenue is about 1-to-1, and the PE is really low. I've been taking my time with this one because if you look at their fundamentals look excellent. But I want to get to know them a little bit better. The courtship before I buy shares in this company is going to be a little longer because it's a small company. It's really moving today. Look at that. Holy smokes. Over the 30-day, up 59%. Holy smokes. That's really moved. I've been tracking this stock for a couple months. So this is an exciting stock. Look at that drop. It really dropped. And the market just is, having this stock go up and down and all around. When is it going to announce? November 29th. Wow. That's going to be an interesting earnings. But to give you a sense of what these guys do, they deliver furniture. So you order it online, you go to some e-commerce site, you love, a set of furniture, these guys will deliver it. And that's what they do. And they partner with companies that sell these bigger items. And I think they serve certain metropolitan areas, right? They're not going to be delivering to, the boonies, so to speak. It's going to be metropolitan areas where they've established their warehouses and can deliver these items. So that's what this company is about. Is it a long-term hold? I wouldn't view it that way. I think it would be more of an opportunity, to make a good return, kind of like how I've gotten into Zim, got out of Zim, made some good money, got out of it. This, if bought at the right time, could really, really work. It's really working today, up 6%. Holy smokes. Beautiful. And is there any news that's driving that? Nope. Just people want to buy the shares. So that's Giga Cloud. Right now, I feel like the market's expensive. And if anything, I'm looking to probably reduce the stock out of my portfolio in the month of October. And I'm okay with, keeping my current positions, my biggest position being Meta and then Google Alphabet and so forth. But these tiny little companies, they're interesting. They can really do something, but it's hard to throw a lot of capital at them because it's higher risk. When you go to a small company, they could surprise their next earnings on the 29th. They could really lay an egg and be like, oh yeah, our business is going away because some big logistics companies kind of out muscling us and forming stronger partnerships with the big e-tailers. If that happened, the stock will tank, 25, 50%, and then you're holding the bag. So right now I'm careful not to jump in head first too early on these really small caps. That's Giga Cloud, super exciting. I mean, look at that stock go. And I don't know what you plan to do with it, Bobby, but that's my review of it. I think it's an interesting stock. When we look at their fundamentals, look at this growth, just superb growth. You think about their business, it's like, yeah, it totally makes sense. The consumer has moved to online purchasing, right? And what is I would say a more recent growth area is bigger items, right? 10 years ago, 20 years ago, we're buying little items, everything through UPS, FedEx, and so forth. And now you're buying everything. Like, why would you want to? I mean, you can go to a furniture store maybe to get ideas and stuff. But if you kind of know what you want, you just get it online. Or maybe you go to the furniture store and you say, I kind of get an idea of what I want. Let me go shop it online, and you buy what you buy something that you think you saw, and you buy it at a better price, maybe better terms, and bingo. you're using GigaCloud for the logistics. It gets delivered to your home and you are happy with whatever item you bought. So it makes sense that, hey, economically, they're in a fertile space. I think their focus is also really, really good. They might even be an acquisition target. So let's see how that plays out. Keep asking about it. I'm careful not to buy too many small caps because I think the stock market is expensive, but small caps are beginning to work. Might have to get a little more interested in GigaCloud. I told myself, since I'm in LA, these guys are located, not too far from where I live, and the route to go to visit my mom is I could go by here and maybe take a look on occasion. So I might do that. So this is where their stock's been over the last year. It's really moved. Look at this volatility. Holy smokes. And this is what I'm talking about, that, very quickly, like over the course of a couple of weeks, this stock tanked 40% over the course of what is about 3 months, 4 months. The stock went down 58%. So this one's like, really moving now. It's up 58% from that low, but this one could be, quite volatile and risky. It's gone up nicely. They have one bad earnings without a big brand like a Procter and Gamble. They will really tank. They have a good earnings. They'll continue to flourish. They'll continue to go up. So you look at their stock chart when they first announced, I don't know how they were $48 a share. Then they sold off like nobody wanted them. And then they really rallied. So welcome to the stock market, small caps. And they still haven't made it back to their IPO price. I can't believe they IPO'd that high, but they did. And whoever bought early paid the price. So yeah, Bobby, it's an interesting, everything you look at this stock, it kind of pulls you in, so to speak, but I'm just, conditions in the marketplace are, US stocks are a little expensive, and I'm trying to be careful. I'm having a really good year from a performance standpoint, a return perspective. It's almost like, happy with the return and realize that, hey, we may be sitting on an expensive stock market. Is it going to perform like it did for the last 2 years? Maybe it doesn't. Maybe it goes down a bit. And if it goes down, I want to have cash ready to buy at better discounts. So speaking of better discounts, let's take a look at what sectors are moving. And since it's Friday, also take a look at the 1-year change. So communication services are really moving. Netflix is part of communication services. So Netflix is probably a good part of this positive number. The worst place performer is energy. We just looked at Schlumberger, back to that oil price. It's just low. Financial services a little low. Consumer staples a little low. Healthcare a little low. But technology, consumer services, and materials are really rocking. For the past year, needless to say, technology's just been crushing it. And over the 5-year, just stupendous returns. And in second place for the 1 year looks to be financials. And, not too long ago, it was communication services. So financials have really rocked. And the banks have had a very good earnings season. Financials have done well because interest rates are going down. The economy is supposed to be good. So they're probably not going to have to write off as many loans. So financial services companies are going to do well, quite well. So then in third place, communication services like Netflix, Google, Amazon, Google, Alphabet, Meta's in there, Disney's in there, Comcast, and the likes. That's a pretty strong rate of return. And exposure to that, I'm probably overexposed to communication services because my two biggest holdings are Meta, Google, Alphabet. I'm okay with that. I used to own Netflix, so I was super overexposed, and I made money on Netflix. So thank you very much, Netflix. I made enough money to pay all my subscriptions for my lifetime, and that's a good deal. So That's what's going on from a sector perspective. Let's cross the Pacific and go over to China and see what's going on, China. It's a good day. It's a good day. The China market is really working today. That it's good to see. It's good to see a positive day because it's been a rough week for China stocks. Let's see if the economic data creates a longer lasting run for these stocks. I mentioned that US stocks are expensive. It's really hard to find a discounted stock these days. You go to small caps like GCT, it looked really good, but it's a small cap. It's risky. Got to take a lot of risk. And other stocks, are pretty expensive, especially high growth stocks that are well known, like Palantir's expensive, Nvidia expensive, right? But you go over to China and you have comparable businesses, and their fundamentals just are really discounted. Of course, it's China. Now, I like the investment in China because I get to invest in that economy, which is a high growth economy that is very large, second largest in the world. At some point, will be larger than the US. So, becoming a good investor in China, I think, is going to be important for my performance for the next 10, 20 years. So, it's a long term, I want to get knowledgeable. I want to get more knowledgeable on India. And that's another reason why I invest in China and get more familiar with it. Right now, I'm in Baba, JD, NetEase, Baidu, and I'm in a ETF where the biggest holding is Tencent. So I'm glad I'm in that. I'm not jumping in head first. I accelerated my buying a couple weeks ago. So far, it's okay. I'm expecting that this space, if it works, it's going to double in value. It's going to double in value in the next year or 2 years. And we'll see if it happens. It's having a good day today. All right. So good morning, Tomas. How are you? And good morning, Impulsive Hamwich. Yeah, you're long with some of these Chinese stocks, as am I. I think long term, the global economy, right? The economy, we get so much stuff from China, and the world economy has become more connected. The velocity's increased. I mean, you're literally buying stuff from all over the world, and you realize it because when it gets to you, you know where it's made. But it's really we're quickly becoming kind of like one economy. The center of excellence for manufacturing for this is here, and it's easy to buy products from there. Barring, governments having a bunch of, tariffs and stuff, which would make it, less desirable to buy from a company or a country where you would have to pay a big tariff. Barring that, the rest of it where you can, really see the global economy hit stride. But China is really getting it done, and they're getting it done all over the world. I know that there's a certain perception here in the US, but we'll see how things play out. Netflix is getting it done. 10%. I sold my Netflix. I made money on it. Now I manage my older son's portfolio, and Netflix is a big position in his portfolio. So I think he's going to give the old man a pat in the back for holding Netflix on his behalf. He's a great kid. He's not into stocks so much. I am. So he lets me manage his fund, and so far so good. I've made a good return for him. And Netflix is one of the stocks that he's held for a long time. So it's a good day for his portfolio. And these guys, Netflix is the dominant paid streaming company. They and YouTube are the dominant platforms. YouTube being bigger than Netflix, but Netflix has really worked. But here's what the market will offer you from time to time. It'll tell you, hey, investor, that Netflix is, just dominant, the leader, the innovator. But we, for whatever set of reasons, believe otherwise, and the market sells it off. It becomes undesirable. sells it off by 74%. Holy smokes. The stock market knocks on your door. Opportunity is a knocking. And buying these great companies when the market knocks on your door is a great idea. I bought big. Big for me is like 50 grand. And I did really well. Now, I sold like here. Thank you very much. Made my money. And the reason I sold is I was too much into communication services. Got Meta, got Google Alphabet. I'm like, dude, what's the deal? You got to get rid of some of that. And I took that big gain. I'm satisfied with it. It's continued to go up. Good for them. I think it's fairly priced, but I think that Netflix, one of the things that I don't like about their business, and I like the YouTube business more, that's owned by Google Alphabet, is the cost of their production. Like every time they come out with a show, and especially like one of these really good shows, they have to spend a lot of money, like hundreds of millions, and I would say billions if you add it all up, on content development. So that is going to be interesting how that plays out. And they've gotten to this point. They're a really large cap, but I think that's one of the things I don't like. They're also a one-trick pony, so they're not really well diversified. They do streaming. The good thing is that they've been growing globally, which is great. That's, the addressable market in other countries is quite substantial. So that really looks good. The stock's certainly moving today. It's been a winning stock, but I wanted to just kind of show that, I'm looking forward to the days when, we do have a nice correction like we had in 2022, and you have a lot of discounted stocks. This is the time to make money. You buy them here and you watch them go up. So we'll be waiting a while on Netflix. I think the market's probably learned their lesson and will not do this again, because I'm sure a lot of the people that sold here, and some famous people sold along the way, really regretted it. They're like, oh man, I should have hung in there. But that's Netflix. Congratulations. Applause for Netflix. Great job. So Mike, someone on the Discord mentioned CVS. Yeah, so let's take a look at CVS, and I'm going to look at CVS, and I'll look at Elevance. Make sure. Yep, looks good. So CVS is tanking, and well, it's kind of recovered a little bit. It's down 8.47. Now there is a lot of value here. This is a healthcare stock, and there's some things that you look at fundamentally and just very desirable. I may end up getting back into CVS because I just can't ignore some of this value. So, obviously they pay a nice dividend, 4.5. It's a buy rating compared, if you look at the price targets analysts had, let's look at their financials. Growth, top line growth. Why is the stock on a downward trajectory of this magnitude when a business is growing in what I consider to be a safe industry, a safe sector, which is healthcare? That's pretty darn interesting that it's sold off so much. But the story on CVS is like it's undesirable stock. The market does not like it. I like healthcare stocks, but the market just is not paying a premium for them. And this stock here has done well. Let's look at their cash flow. So the cash flow was phenomenal in 21 and even 22. And they've taken a haircut. Okay. Let's look at the quarterly to see what's going on more precisely in free cash flow. So free cash flow, they had a negative quarter at the very end of 2023, but there looks like they had a positive quarter in Q1, positive quarter Q2. So just valuing the company on what I would consider to be a pretty safe free cash flow rate because their business is bouncing back. We're not going to stop going to the pharmacy and getting our pharmaceuticals. We're not going to they have a health insurance company as well. We're not going to stop using them. We're not going to stop going to the doctor. These guys are a necessity to our economy. So if I just use an expectation of like 10 billion in free cash flow and just multiplied it times 10, just being super conservative, discounted all the way. This is highly discounted. And I happen to think that CVS is it's gonna be very investable at some point, and this is gonna be a good stock. So I might have to take a peek at CVS and buy into this troubled company. And the change in the CEO, does that how do I view that, right? And I think it was, several, I would say a couple of super investors commented on this. Um, the CEO is not the business. The business is the business. A very desirable business is a very desirable business. If it's a highly profitable, high free cash flow business, the CEO can help, the CEO can hurt. But fundamentally, the value of that business is based on the type of business, their profitability, and so forth. So the change in the CEO doesn't make a big difference to me. And I would just say that it's probably a good idea, just kind of change the tone, so to speak. Um, and I think this has gotten really interesting. If anything, you could just hang in there for that 4.5% dividend. It's not a bad rate of return. I mean, the news has been so bad. Can it get any worse? Can it get any worse? We're down to the levels where we were, during the COVID. So I'm liking the stock. And one of their competitors, a substantial one, Rite Aid, is bankrupt. So they're going away. It leaves more addressable market for CVS to go after. So CVS, I might have to add some shares and see where that goes. So Mike, if I've gotten to know you right, you like discounted stocks. You might be feeling like I'm feeling, but that's where my head's at around CVS. And Android PC, you're thinking CVS. Uh-oh. We're all thinking CVS. All right. Well, good luck with it. It's just my observation, not financial advice, of course. And good luck with your analysis and your decisions. Tomas, you want to look at Nestle. Nestle is a big powerhouse food company. I believe it's a Swiss company. So this is Nestle. And which one am I going to look at here? Is it traded in the US market? Yeah, this is in Switzerland. So I'm very familiar with Nestle. They're a powerhouse. I mean, 221 billion, and this is in the Swiss currency. And so each Swiss franc is worth $1.16. So we got to add to some of that market cap that we just saw. So this, that's Netflix. Kind of sounds like Nestle, but not Nestle. So we'd have to add like 1.6, which that's going to add this is like a 260, $270 billion market cap company. So it's a big company with big revenue. It's successful. It kind of goes around the world and adapts to that culture and really sells. I'm familiar with because Nestle's here in the US, but they're also down in Mexico. When I go down to Mexico, I see people use their products, and I'm sure they're huge in Europe. I bet you they're pretty big in South America. So this is a very well-known brand. This is a safe stock. Their industry is a lot like Procter & Gamble. It's a consumer staple, and it's packaged foods. So we need food. We're not going to stop eating food. So They are all over the world. They're all over the world. These guys are really successful. And so they're diversified globally. They have a PE of 20, PE of 18. Dividend looks pretty good, 3.5. Financials, they have had their revenue go down a little bit. And I'm going to guess at why is we had inflation during 21 and 22. And inflation may have caused some of this growth because you can see that this is a slow grower. Now, during COVID, we had lack of demand probably for some of their products, and it caused a revenue loss. I give companies a pass during COVID. That was an unexpected pandemic. But this could have been growth due to the inflation. And same story applies to revenue drops. Once we got through that inflation curve, now that prices are lower on commodities, food prices have dropped, and their their product prices have dropped, and therefore their revenues dropped a little bit. We look at where their stock's been over the last 5 years. Boy, it's really on a downturn. Look at that. Huh. That's a down graph there. Let's take a look at. So they are from the peak to the bottom, 32%. Okay. So their revenue has been up and down, free cash flow, really stable. Nice. 11 billion. It's an expensive stock, and I'll tell you why is their market cap's 221. Their free cash flow is 11 billion, right? And they're not really growing. So I'd multiply it to their free cash flow times 15 because it is a very good name, but just their cash flow isn't there. People are buying into Nestle because they know the company. They're very comfortable with it. They're probably consuming a lot of their products. When I think of Nestle, I think of hot chocolate because that's the hot chocolate that I've been drinking since I was knee high. I was a little boy. We have Nestle hot chocolate in our cupboard. So it's got a positive brand with a lot of people, and investors are people, man. So they're very comfortable buying into it. Can this stock work? Absolutely. It's just going to be a stock that you kind of buy it and just have it there as a stable stock. I don't expect this stock's going to double in value in the next 5 years. I think this stock can do 30 to 50% return over the next 5 years, which could be a really good return for somebody, especially in a nice, safe stock. You get, some diversification around the world. That could be the reason why an investor might be interested in Nestle. For me, I'm good. I wouldn't buy into Nestle because, again, I know how to get a yield with low risk. And the difference between that and investing in Nestle, the return isn't very different, but the risk is quite high. Nestle can, not that it's going to happen, just saying when you deal with food, you can deal with significant problems. They could have products that, maybe cause people to get sick in a particular region and their brand takes a hit. Not saying it's going to happen, but, just when you deal with food, you're dealing with, a lot of problems. And it's not a stock that I would want. I think it's a stable stock, would have a pretty decent rate of return. For a young investor, I don't know that Nestle would, I manage a 24-year-old son's fund, right? And he's in high growth. He's in Meta, Netflix. He's in some biotechs. And nowadays it's crushing the market. It's doing really well. That's what I would think, to an investor that's 30, 40 years old. Is Nestle a good hold? For me, it wouldn't be. I don't want something that's going to double quickly and really give me a high rate of return. So Just some comments on Nestle. It's just how I see the world. Hopefully you found it interesting, Tomas. Thanks for asking about Nestle. I'm going to have some hot cocoa later. All right, Mike, thanks for joining. I appreciate it. All right, so let's land the plane. Let's take a look at the stock market. Stock market, what's going on? NASDAQ still working. The Russell in the green, just slightly. S&P up. Dow is down a little bit. Procter & Gamble is weighing down the Dow Jones. And that looks interesting. Netflix is still on a tear. Coinbase, man, that stock's really moved. It's really moved from this level to this level. That's a 38% move. And actually the move is shorter than that. Over 8 days, it's up 31%. Beautiful. I owned Coinbase. And I've certainly noticed it. Rising in value. All right, everybody. So let me wish you a very nice weekend. If you're thinking to yourself, oh, the weekend, boy, it'd be nice to message some other investors who love investing, who are doing their analysis over the weekend. Look us up on Discord. Here is the Discord details. Just be careful. There's scammers. One reached out to me yesterday. Scammers. They're trying to get a hold of, us and scam us. But be careful on Discord. But you can chat with other investors on this Discord server. It's been really interesting for me. I'll be back. I'll be back on Monday, same time, 9:30 Eastern. We'll go over those earnings announcements. I don't think there's much going on Monday. I could be wrong. Let me take a peek. But I think Mondays I take that back. There's a lot going on Monday. No huge names, though. Just a lot of names like SAP is announcing, Nucor, which is a steel company. And then some names that are not that familiar, at least to me. So Monday we'll have a lot of activity, but not a lot of big names. But next week, there will be some massive names. Tesla on Tuesday, T-Mobile, Thermo Fisher, which is big, ServiceNow. I mean, there's some big names that are coming. Coca-Cola. And it's just going to keep going, man. It's going to keep going. Then on it looks like on Friday, Amazon, Union Pacific. And we've got some big names coming next week. So it's going to continue to be super interesting. So tune in when you can and become a member, sponsor the channel, and join us, on the investor calls, both to do some analysis, do some workshopping, as well as just talking about stocks and so forth. So take a look at the details, get signed up. I'd really appreciate that. And with that, everybody, let me send you off with I hope you have a great weekend and hope you made a lot of money this week. Let's see how the day trades and let's see what next week has in store for us. Everybody, thanks for tuning in. Take care.